I welcome you all again to Executive Masterclass Tutorial Center. Please, our location is at Ashoman Estate, A-Line. Please, today we're going to continue with our part 6 of our consolidated financial statement. And the last time we were discussing how that the 5 basic workings are going to be working and how that you're going to understand it. So we ended with the goodwill aspect, whereby I was explaining how you get the consideration transferred. So I started with the cash payment, and also I continue with the share exchange. So today I want to let's say elaborate some key aspect on how that you can deal with your share exchange, because I made mention of it that sometimes the examiner will tell you that the share exchange has not been recorded. So how are you going to record it? So therefore, if that is not been recorded, it has not been recorded, or is yet to be recorded, therefore you need to record it. You're recording it, therefore you need to make sure that you are sharing it between the share capital and the share premium. So I started with a question. So today I'm going to continue how that you're going to share it. I remember the number of shares that the M Limited was having was 8,000 shares. So M Limited issued 8,000 shares. Let me see, okay, K Limited. So M Limited was the subsidiary, K Limited was the parent. So K Limited issued a share exchange of, and the number of shares that was issued as a share exchange was 8,000 based on the computation when you check the part 5 of our consolidated financial statement. So now, when we said that, I told you guys that anytime you are doing share exchange, we always use the parent share price. We always use the parent share price because it's the parent who is what? Issuing the share exchange. So we need to use the parent share price. So based on the question, the parent share price was 4.50. So if you want to know the amount that maybe this 8,000 shares is going to be accounted for, therefore you just have to multiply here by what? 4.5. So multiplying here by 4.5, we had Ghana 36,000 cedis. So 36,000 cedis. So this one will be the shares, the amount in shares, that the parent is going to what? Pay to the subsidiary for acquiring the shares in the subsidiary company. But the issue is that, like I said, sometimes the examiner will make you know that the share exchange has not been recorded, therefore you need to record it. So in this case, we need to record it by sharing it between the share premium and the share capital. So this 36,000 is supposed to be shared between share exchange, that of share capital and share premium. And share premium. And because of this, like I said the other time, in part 5, the share premium comes in whereby the number of the amount that the nominal value of the shares that the parent is supposed to issue, but the parent has issued in different what price. So the parent nominal value was 2 cedis, but the parent issued it at what? 4.5. So because of this, the share premium will be the excess amount that the parent has charged. So here you can see that the share capital, in the share capital aspect, is supposed to be 2 cedis. So it's supposed to be 2 cedis times 8,000 shares. Then the excess of the 4.5 will be 2.5 Ghana cedis. So that one will be the share premium. That one too will be multiplied by what? 8,000 shares. So in total, when you multiply the 2 cedis by 8,000 shares, we are having 16,000 Ghana cedis. So this amount will be the amount that you're supposed to add to the share capital. The share capital. Then the remaining figure will be your, when you take your 2.5, let's say, let me get here, 2.5 times your 8,000, it's giving me 20,000. So 20,000 Ghana cedis, 20,000 Ghana cedis. So 20,000. So this is how that a share exchange will be shared. Anytime that the examiner tells you that the share exchange has not been recorded, or yet it is yet to be recorded, therefore you need to share it between the share capital and the share premium. So this is how that is supposed to be done. But in some cases, maybe the share premium will not be there, but the examiner will tell you that the share exchange has not been recorded. So what you do is that when you calculate to get your total share exchange amount, you just add it to the share capital figure in the let's say in the statement of financial position of what the the parent company. So you just add it to it so that you get, because the subsidiary one has been used when you are doing the net asset of the subsidiary at workings too. So this is how that exchange is going to be done. Then the next cash, the next consideration transfer that I'm going to deal with is deferred payment or deferred consideration. Deferred consideration or payment. Let me use payment or contingent consideration. So okay, so the next consideration transfer is deferred payment or contingent consideration. So one may ask, what is meant by deferred payment? So deferred payment comes in whereby the parent company, instead of the parent company to make some specific amount to the shareholders of the subsidiary, they will defer the amount that they are supposed to pay. So they can tell that of the subsidiary company that, oh, you pay it in a year later, or we pay it in what? 2 years' time. So that's where that deferred payment comes. It means that they have deferred the amount that they are supposed to pay. And when it comes to the deferred payment, the issue is that deferred payment are additional amount that the parent is going to pay to the shareholders of the subsidiary. But in this case, it comes with no condition. It comes with no condition. That's the deferred payment. But when it comes to the contingent consideration, that one too is a promise that the shareholders of what? The parent has what? Or the parent has promised the shareholders of the subsidiary that, oh, we will make some additional payment to you if that there is what? Some specific conditions what? Are met. You get it? So the difference between the contingent consideration and the deferred payment or deferred consideration is that the deferred payment comes in with whereby there will be a payment in the future, but there is no what? Condition. But the contingent consideration comes in whereby the subsidiary will receive an additional amount from the parent, but it will come with what? A condition. So now, let me show you how that you can do the calculation for the deferred payment. And anytime there is a calculation or anytime the examiner tells you that there is what? The deferred payment, what that you have to bring, how that you have to think about is that probably there will be a finance cost. There will be an interest. There will be an interest that you need to what? Calculate. So let me have this one so that I'll make you know how that this one is going. Assuming maybe the amount to be paid. Assuming the amount to be paid. So let's say the amount to be paid is, let's say, 5,000 cedis, and it will be paid in a year time, 1 year time, 1 year time. That the parent company is supposed to make the payment to the subsidiary. So because of this, we need to discount it, or we need to what? Bring it to the present value. We need to bring the 5,000 to its present value. So bringing it to its present value, that's where we are saying that we need to what? Use what? A discount factor. We need to use a discount factor. And the formula for a discount factor is equal to 1 over 1 plus r power n, where the n represents the number of years, the r is the rate or the discount rate, so or the cost of what? The cost of equity or the cost of capital of what? The parent. So you just bring in here, then you get what? You discount it from the future to the present terms. So that's how you do it. So this 5,000, we can what? Discount it. So let's find the present value of it. So we find the present PV will be equal to the 5,000. So you can do 1 over. So assuming the R is, let's say, 10%. So 0.1. So we have 1 over 1 plus the R, which is 0.1, power n. The n is 1 year times the 5,000, which is the future amount. So you just have to do your computation. So let me calculate it fast. Let me calculate it fast so that we can move on with a lot of stuff today. So this is how you're going to do it. So 1 over 1 plus 0.1 power 1 times 5,000. Or you can also do it. You can also do it. 5,000 over 1 plus 0.1. Then you bring your n. That's the number of years to be 1. So here I'm having 4, 5, 4, 5. So 4, 5, 4, 5, 4, 5, 4, 5, 0.45. That's what I'm having. So when you get this figure, this one is the present value, and this will be the amount that will be shown on your what? Your consideration transferred under deferred payment. You get or deferred consideration. But after this, the only thing that you have to think in mind, anytime there's a deferred payment, don't forget that there will be a finance cost. There will be a finance cost. There will be a finance cost or an interest that you need to also calculate. And the interest will be calculated on what? The present value. The interest or the finance cost will be calculated on the present value. So the finance cost will be equal to the present value times the cost of capital. So in this case, the cost of capital is 10% times the post-acquisition period. Post-acquisition, so let's say over X over 12. So we shouldn't forget, anytime you are calculating for the finance cost, we need to take into consideration the post-acquisition period that the organization has acquired the other company. So we need to take into consideration about it. So here, if that we are computing based on these figures, our present value is 45.45. Then we multiply by the cost of capital of the parent, which is 0.1. So here in this question, there's nothing like the. I don't have the post-acquisition period here. So when you start solving question, you get to know how that computation is going to be done. But I just want you to know that anytime you are calculating for finance cost, don't ignore the post-acquisition period. That one too will have impact on the finance cost, as well as anytime you are doing calculation for depreciation, you also need to take into consideration of that. So the 45.45 times our cost of capital of the parent, and we are having 454. Let me end it here. 454. So this one will be our finance cost, and this finance cost is supposed to be added to the finance cost figure in the one that had maybe it is on our income statement. So you need to add this to the finance cost figure on our income statement. And also, in a case where maybe you are not preparing for the income statement, you can also treat this finance cost by subtracting it from the group retained earnings when you are doing workings 5. So when you get there, you understand it. So you can also take it there by subtracting it from the group retained earnings. So this is how that the deferred payment or deferred consideration is going to be done. So ladies and gentlemen, I'll continue with the consideration transfer by bringing in another method or another way that the parent can make a payment to, let's say, the subsidiary. By the fourth one will be issue of loan note. Issue of loan note. Loan note also is another consideration transferred, but in this case, the loan note comes in whereby, let's say, it's a debt instrument. When we start doing some of the standard under IFRS 9 financial instrument, you get to know all this stuff. So the parent can also make payment to, or can let's say make payment to the subsidiary, or can acquire let's say an asset or a shares from another company by issuing loan note. So we need to also take into consideration the issue of loan note. The issue of loan note. The issue of loan note is very similar. It's very similar to the deferred payment or that of the share exchange. So let me see, since I have a simplified question here that I can make us use as an example for the loan note. So let me clean this side. Let me clear this side so that we just see one simple question when it comes to the loan note. Let me clean this side. So the question says that K Limited acquire 4 million shares. K Limited acquire 4 million shares. So K Limited acquire 4 million shares from M Limited. So M Limited is having, M Limited is having 5 million shares. And K Limited has acquired 4 million of it. Then the acquisition was financed by an issue of $100, 50% debenture, $100. So the acquisition was acquired by using $100. So let me use CDs. Since that we are in Ghana, let me use CDs so that it will make this one. So 100 CDs 100 cedis, 15% debenture. 15% debenture. So the acquisition was financed by an issue of 100 Ghana cedis, 15% debentures for every 1,000 shares acquired. For every 1,000 shares acquired. For every 1,000 shares acquired. So this one too is very similar to how that we did the share exchange. When it comes to this, K Limited has issued 4 million shares, has let's say issued 4 million shares, or let's say has acquired 4 million shares out of the 5 million shares of M Limited. So probably if that you are doing the good structure, everything will show clearly that the K Limited is going to be the parent and the M Limited is going to be the subsidiary. But here in this case, this one is 100 cedis for that of 15% what debenture, and it's going for every 1,000 shares acquired. So in this case, you can say that if you want to know the number of, let's say, the amount that it will correspond to that of the 4 million, here, if 1,000 shares is going for what? 100 cedis. If 1,000 shares is going for 100 cedis, then 4 million shares will give us how much? So if you want to know the, so 15% debenture, so 15% debenture, 15% debenture. So if 1,000 shares is going for 100 cedis, therefore 4 million shares will give us how much? So 4 million shares. 4 million shares. It will give us more. So if more, let's divide. So 4 million shares divided by 1,000 times what? 100. So let me use my calculator to punch it, and you get this one. So 4 million divided by 1,000 shares multiplied by 100. This one is giving me 400,000 Ghana cedis. So 400,000 Ghana cedis. So 400,000 Ghana cedis. 400,000 Ghana cedis. Yeah. So this is how that the amount. So this will be the amount that the parent is supposed to pay to the subsidiary. 400,000. But mind you, this one also you need to calculate what? A finance cost. You need to calculate a finance cost on it by using what? The 15%. So you need to calculate finance cost. So the finance cost, like how I told you, is going to be the same method. So if you, anytime there is a loan note, you need to calculate a finance cost. So finance cost. This one too will be 15% on the present value. 15% on this figure that we are having here. So 15% on the 4 million Ghana cedis. 400,000 Ghana cedis. Sorry. 400,000 Ghana cedis. So you multiply it to get the finance cost. You multiply it to get finance cost. So we are having 60,000 Ghana cedis. So 60,000 Ghana cedis. 60,000 Ghana cedis. So, ladies and gentlemen, this is how that the loan note can also be calculated. And this figure, the finance cost, can be added to the finance cost that is already been given in the question, or you can go straight to the group retained earnings, then you subtract it from there. So this is how that the consideration transferred. There are 4 methods that you can go through before you can get the consideration transferred. Then after that maybe you see you need to add the fair value of the NCI. All those things I will treat when I'm doing the workings what? The workings for. When I'm doing the workings for. So this what that this one is going to end. I'll end the workings 3 here. That's the goodwill. Then I'll proceed on with the workings 4, which is the NCI of what? The NCI at reporting. NCI at reporting. So let me clean this side and continue with the workings 4 of the consolidated financial statement. So workings 4. NCI at reporting. NCI at reporting. So we bring our CDs. Okay, so now what we need to bring up is that we need to bring what? Our NCI at acquisition. NCI at acquisition. And this one will come from when we are doing our workings 2. When we are doing our workings 3, the goodwill aspect, the NCI at acquisition will bring the same figure here. But one may ask, how are we going to get the NCI at acquisition? That's why I was saying that in some cases, when it comes to the NCI at acquisition, we have three ways whereby the NCI can be valued. The NCI at acquisition can be valued. So one aspect is that the parent company, or it can be their policy, or the parent company can value the NCI by, let's say, giving a specific amount. So in the question, you can see that, oh, the parent company is a group policy that the NCI will be valued at, let's say, 50,000. So that one, they have already given you, let's say, they are valuing the NCI at fair value, and the amount is, let's say, 50,000. So that one, you bring it direct. You bring it direct. That's the first method. The second method is that the parent company, it can be their policy, or they can value the NCI through what? A fair value. Based on what? The ownership in what? Based on the ownership, the number of shares. So they can value the NCI at fair value using the number of shares, ownership in the what? The subsidiary. So this is a case whereby, let's say, based on this, let's say if that I'm using the K Limited was having what? Acquire, let's say, 4 million shares from 5 million shares of M Limited. So now you can see that now M Limited will be left with what? 1 million shares. So that 1 million shares, what that will do is anytime the parent company is valuing the NCI through what the remaining shares the NCI is having, or the subsidiary is having, by its ownership, you just have to what? Multiply. You just have to what? You have to come and do. Let's say the total number of shares was 5 million. Then the parent has, let's say, acquired to 4 million. So now it left with what? 1 million shares. So then this 1 million shares, this is how that the parent is valuing what? The NCI. So if you want to know in amount, we are saying that anytime there is what? We are issuing they are valuing the NCI through the number of shares of, let's say, the NCI. What we do is that we need to multiply it by the share price of the subsidiary. We need to multiply the amount remaining, the amount of shares, or the shares remaining, by the price of the subsidiary. By the price of the subsidiary. So in a case where maybe it can be like in a question, if that you recall what we were doing when we were doing the other one, we realized that the share price of the subsidiary was also what? 6.25. If that recall to our previous videos, the share price of the parent was what? 6.25. So you just have to multiply here by 6.25 Ghana cedis. So you just have to multiply so that you get to know the number of the amount that is for the NCI. So maybe 1 million times 6.25, you get something like 6,250,000. 6,250,000. So that one will be the figure, 6,250,000. So that's it. That's it. So this one is the second way whereby the NCI can be valued. So in this case, the first one, they value the NCI through fair value, and they just gave the specific amount. This way to the second option that I'm treating here too, or the second method, they have valued the NCI through what? Fair value. And this is how that they are saying that based on the ownership of shares, or the number of shares that the subsidiary is having. And we have multiplied it by the share price of the subsidiary. So this one is the second method. So since that they are valued, the parent is valuing the NCI through fair value. The first one was through fair value. This one also is through fair value. Therefore, what that you need to do is that you are going to, anytime you calculate, anytime you do the you are doing your calculation, or you read the question and you get to realize that there is what? Impairment in goodwill. Anytime the parent, you should note that anytime the parent value the NCI through fair value, anytime the parent value the NCI through fair value, therefore, if there is any impairment in goodwill, it was supposed to be shared between the parent and the subsidiary. Don't forget it. Anytime the parent value the NCI through fair value, then if there is any impairment in goodwill, it will be shared between the parent and the subsidiary. I hope you get it correct. So let's go to the third step, or the third method. The third method is that this one too, the parent is going to value what? The NCI, but this one is not going to value it through fair value, but it's going to be what? A proportionate of what? The net asset at acquisition. The net asset at acquisition. So the NCI is going to be valued through a proportionate of what? The net asset of the subsidiary. So that third one will be whereby you go to your working stew. Your working stew, if I remember, you were having data at acquisition, data at reporting, when you finish the computation, we got to realize that we had the total figure for the net asset of what? The net asset at acquisition. So that figure is what that the parent is referring to. That figure is what the parent. So you come and take the total figure of what? The net asset of the subsidiary at acquisition. Then you multiply it by the percentage of shares that the subsidiary is having. So maybe in a case where, let's say, you had a total of the net asset of the at acquisition to be, let's say, 50,000. If that you had it to be, let's say, 50,000, the net asset of the subsidiary at acquisition to be 50,000. Then what that will do is that since that the parent is valuing the NCI proportionate, therefore we need to multiply this 50,000 by the percentage ownership of the subsidiary. So if that the parent is having, let's say, the subsidiary is having 20%, you just multiply it by 20%. That one will give you the figure. That's all. That's all for it. So these are the three methods that you can go through to get the what? The NCI at acquisition. The NCI at acquisition. And this is the figure that you take to the group when you are doing the working three under goodwill. Because when you get your this one, your consideration transferred, you need to come and add what? The NCI at acquisition. And these are the three methods that you can get it. So the last one, if that the parent value the NCI at proportionate by using the net asset of the net asset at acquisition of the subsidiary, then you multiply it by the percentage ownership of the subsidiary. That one will give you the figure. So that's what you use. But in this case, whereby they are valuing it through the proportionate, therefore, if that there is any impairment in goodwill, it is not going to be shared, but it will only be borne by the parent. Get it right. There is a two difference between the two scenarios that I've given. The first one I said, if that a parent value the NCI through fair value, if that there is any impairment in goodwill, it's supposed to be borne, it's supposed to be shared between the parent and the subsidiary based on their share ownership. It's supposed to be shared between them. But in a case where the parent value the NCI through what? A proportionate. Therefore, if there is any impairment in goodwill, it's going to be borne by only the parent. So it's only the parent that is going to incur that impairment, but it won't be shared. It won't be shared. And I know that when it comes to the impairment in goodwill, it will have effect in the parent aspect, whereby when you go to, let's say, the group return earnings, if there's any impairment in goodwill, you go and subtract it. You go and subtract it. And also, if there is any impairment in goodwill, when you come to the NCI at acquisition at this side. So let's say we have gotten our NCI at acquisition, you have brought it here. Then what that you are going to do is that we need to bring any NCI share of PAP post-acquisition period. NCI share of PAP, you bring it. If that is profit, you bring it. If that is a loss, you bring it. Because the PAP will comes whereby you do your workings too. The difference between the total of the net the net asset of the subsidiary at acquisition and at reporting, the difference between the two will give you the post-acquisition profit. The post-acquisition profit, that's the PAP. So it can be post-acquisition profit or loss. So if it is a loss, you bring it. You negate it. If there is a positive figure, you bring it like that. So the share that the subsidiary is going to have is what that you bring when you are doing the NCI at what? Reporting. Then also you need to also bring what? The NCI share of impairment. And this one only comes in where the parent value the NCI at what? Fair value. So you bring this one too. You bring this one too. If that the subsidiary or the NCI pays for any dividend, so dividend paid. So dividend paid. Dividend paid. You need to come and subtract. You need to come and subtract. You need to come and subtract. So the NCI share of PAP, the NCI share of impairment, and the dividend paid, you need to bring all these stuff together. You need to bring all this stuff together. So when you do it, then it's going to give you the total of NCI at report. And this one will go to the when you are doing your group consolidated statement of what? Financial position, it will go beneath the equity side. It will go beneath the equity, the total of this figure will go beneath the equity. So that's how that this the workings 4 is going to be done. So let's move quickly to the workings 5. The workings 5. The last workings. The last workings. The workings 5. The last workings. And the workings 5 is group retained earnings. Group retained earnings. Group retained earnings. Group retained earnings. So the group retained earnings, what I do is that you need to first bring your, you first have to bring the retained earnings what brought forward. Retained earnings brought forward. So retained earnings brought forward, you will pick this figure from the statement of financial what position when it comes to the equity side. Then you concentrate on the parent aspect. You concentrate on the parent aspect. So you bring it from that side. You bring it from that side. Then if that, let's say, there is any, because you see retained earnings is an accumulated what amount. That is, let's say, an amount that has, let's say, after the organization pays for its taxes and also paid dividend to its shareholders, the amount that remains will be the retained earnings. So it's not for a specific year. So it's for what? A number of years that they have what added that amount together. So it's an accumulated what amount. So if there is any profit, you need to also bring it. So profit for the year too will be added to it. Profit for the year. Then, if there is any, let's say, dividend, any dividend received, we need to come and subtract it. So dividend received. You need to come and subtract. And also, if there is any impairment, remember, if there is any impairment in what? In goodwill. Impairment in goodwill. Impairment in goodwill. So you need to come and subtract. Impairment in goodwill, you need to come and subtract. And also, if that there is even if there is any investment in associate, if there is any investment in associate, whether maybe it can be a post-acquisition profit or loss from an associate or maybe from the subsidiary, that one you need to what? Bring it up. So since that I've brought the impairment in goodwill from the parent aspect also, let me also bring, it can also be from the associate. So the impairment can also be from associate. So impairment in associate. You need to also bring it. So you come and less it. Then, if there is any PUP, like post provision for unrealized profit, PUP. So provision for unrealized profit, so PUP. I'll go deep into it when after this workings 5. That's the intra-group trading. I'll make you understand how that this one will cancel. So let me just throw small light on it. The provision for unrealized profit is going to be negated here because the parent has also, let's say, make some sales to the subsidiary, but the subsidiary was not able to sell all the goods. And in the books of the parent has already recorded some profit that the parent had what added to it. So because of now, they are now coming to be a single entity, or we are consolidating them. Therefore, we need to what eliminate that profit. So that's why the provision for unrealized profit is coming in. The provision for unrealized profit goes into the net asset of the subsidiary. Any case where is the subsidiary selling to the parent and the parent is still having some of the goods, then that's where the difference between the two comes in. So that's it. So we can just continue by having our total of the group retained earnings. And this figure will go to the consolidated financial position, whereby it will be beneath equity. So you can bring this one. So this one is working 5. So when you bring the NCR to reporting as workings 4 under the equity side, this one will come out as what? Workings what? 5 under the equity. So you bring this one as working 4 under equity. You bring group return earnings also under equity as what? Workings 5. So that's how that is going to be done. So ladies and gentlemen, this ends our 5 basic workings. And so I'll proceed on with the intra-group trading, whereby I'll make you know some things that maybe things that is related to sale of goods, maybe sale of assets, reconciliation of what the current asset and some other stuff, so that you proceed on. So that by the time we finish with the intra-group trading, I can assure you that the moment you take any consolidated financial statement question, you'll be able to at least tackle it. You should be able to at least do your best, because I've well explained the steps and how that things that you're supposed to know. So let me clean this and let's say continue with the intra-group trading, where that one will be our last workings that we will do. Then we will follow up with what? A practical question. We follow up with what? A practical question. Okay. So, under our intra-group trading, we are going to discuss sale of asset, sale of goods, goods in transit, cash in transit, and reconciliation of current account. So, intra-group trading. Intra-group trading. Intra-group trading. So some of the things we are going to discuss here, one will be sale of goods. Two will be sale of asset. Three, we will talk about goods in transit. We will talk about cash in transit. Then the last part of it will be reconciliation of current account. Reconciliation of current account. So with this, the intra-group trading comes in, whereby when it comes to IFRS 3, which talks about business combination. So that's the standard that takes into control when it comes to intra-group trading. So IFRS 3 says that the effect of any intra-group transaction must be eliminated in the consolidated financial statement. So IFRS 3 is business combination. And they are saying that since that the organization is now coming together as one entity or a single entity, therefore we need to eliminate any trading among them. We need to eliminate any trading among them. So I'm going to start, but I will start with sale of what? Non-current asset, or sale of asset. Sale of non-current asset. So let me come here. So sale of non-current asset. So I'm starting with the sale of asset, this one. Sale of non-current asset. Okay, so sale of non-current asset, it can be like the subsidiary can sell to the parent, and the parent you can sell to the subsidiary. So the subsidiary can sell to the parent any non-current asset, or the parent also can sell to the subsidiary. So in this case, when it comes to, since that we are going to consolidate them, the IFRS 3 is saying that business combination, they are saying that we should eliminate any intra-group trading. So in a case, let's say in this case, the subsidiary is selling to the parent. The subsidiary is selling some asset to the parent. And the current amount, the current value of that asset is what? Let's say 10,000 Ghana cedis. 10,000 Ghana cedis. But the fair value, when you go to the market, the price of that asset, let's say it is a plant. a plant. The asset is plant. So the current value is what? 10,000, and the fair value is what? 15,000 Ghana cedis. 15,000. So the issue here is that when you say current value, the current value is what? Cost minus what? Accumulated depreciation. So when you subtract our depreciation or the accumulated depreciation from the cost, that's how you get our current value. So in our books, in the books of the subsidiary, the plant is what? 10,000. But when you go to the market, maybe the fair value of the asset is what? 15,000, whereby this is the amount that what? The subsidiary has used to what? Sell this plant to the parent. So it means that when the sales go through, if that is sales, let's say, assuming the sales has gone through, therefore the proceeds from disposal, so proceed from disposal. Proceeds from disposal will be this. But let's say profit from disposal. Let me use profit. So profit from disposal is what? 5,000 Ghana cedis. This amount will be added to the other income. So this amount will be added to other income of other income. Other income. So that's what I will do. So give me a few minutes. Let me change. Packet. Okay. Let me change my marker. It seems it's not giving us the correct this one. So let me change it quickly so that we continue. Okay, I hope this marker is good. So let's continue with it. Yeah, so like I said, this 5,000 is profit from disposal will be added to other income. So this one will be added to the income statement of what? The subsidiary, because the subsidiary who is making the sales of the plant to the parent, and the subsidiary is getting this what? Profit. You get it? So anytime, since there is what? Now we are going to what? Consolidate them. What that we do is that we have to go and what? Deduct this 5,000 from the profit of what? The subsidiary, because now we are coming to consolidate them. So we need to go and what? Let's say debit the profit of what? The subsidiary. We need to go and debit the profit of the subsidiary by 5,000. In other case, if that is the parent who is selling to the subsidiary, we can just also go in there. This 5,000, which is be the profit from disposal, we can also deduct it from the group retained earnings. So when you are doing the group retained earnings at Workings 5, you can go and also what? Deduct this one, because now they are now becoming as what? One company or one what? Entity. So we don't need to what? Let's say make one. We don't need to make any trading between them stands. We need to what? Cancel everything off. So this is how that the non-current asset issue comes in. But in some cases, there will be an issue whereby there will be what? Excess depreciation. Excess depreciation. So in a case where maybe they have sold the asset, maybe the asset, the current value was 10,000 and the fair value is 15,000. Let's say assuming the current value, which that it's what? 10,000 cedis, the remaining useful life is what? It's 10 years. It's 10 years. And the fair value, which is 15,000 Ghana cedis, the remaining useful life is what? 15 years. So with this, if you calculate depreciation, 10,000 divided by 10 years will give us what? 1,000 Ghana cedis. 1,000 Ghana cedis. Then the 15,000 divided by 5 years is given as what? 1,500 Ghana cedis. 1,500. So the difference between these two, which is the excess depreciation, is what? 500. So the difference between these two, which is the excess depreciation, is what? 500. So in this case, what that you need to do is that the excess of 500 will be added back to the group, the parent, or the group retained earnings of the parent, because in the case where it is the subsidiary who is selling to the parent, and in the book of the subsidiary is supposed to be 10,000, but they have sold it to the parent to be what? 15,000, whereby the parent is charging more depreciation with what 15,000. So this excess depreciation of 500 will be added back, will be added to the group retained earnings of what the parent. It will be added to the group retained earnings of the parent. It will be added to the group retained earnings of the parent. So that's how that the calculation is going to be done. That's how that the calculation is going to be done when it comes to the sale of our non-current asset. So let's move on to another one, which is what sale of goods. Which is sale of goods. So let me bring this one here. Let me clean this side so that I'll continue. So that this one should be here. So let me bring the okay. Let me clean here so that I'll bring the second one. I'll bring the second one here, which is sale of goods. Which is sale of goods. 2. Sale of goods. So when it comes to the sale of goods, it's the same scenario. The parent also can sell goods to the subsidiary, or the subsidiary can also sell goods to the parent. So when it comes to this case, what that is going to happen is that if that is the parent selling to the subsidiary, let's say the total sales is what? Let's say 100,000 Ghana cedis. So the parent sold 100,000 goods to the subsidiary. The first thing you need to do is that if you are doing consolidated income statement or consolidated income statement and let's say consolidated income statement, what that you do is that the total sales figure, which is the 100,000, will be subtracted from what? The parent what? Revenue, and also the subsidiary's what? Revenue. So so you calculate it, you subtract it from the revenue. The whole 100,000 is subtracted from revenue, and also it will also be subtracted from cost of sales. So let's say anytime there is a sale of goods from the parent to the subsidiary and the amount is 100,000, what that you do is that I will show you how that you do the computation when it comes to the let's say when you are solving the question. So let's say you have another revenue side. Another revenue side. We are saying that let's say you bring the parent revenue, then you add the subsidiary's revenue, then you come and subtract this amount from it. So the 100,000 will be subtracted from here. So that's what I mean. You come and subtract. So you add the parent figure, you add the parent revenue to the subsidiary revenue, then you subtract what? The 100,000. Because as I said, we are based on the IFRS 5 business combination. Since that now these two companies have become one, therefore there shouldn't be any trading among them. So we need to we need to make sure that we are eliminating any trading amongst them. So when it goes to the revenue, you have to subtract the 100,000 from it. Then when it comes to the cost of sales, the cost of sales you bring the parent cost of sales, you add it to the subsidiary cost of sales. Then you come and subtract the same 100,000 from this. So you come and subtract it. So that's what I will do. But in the question, maybe they will tell you that the amount of 100,000 that the parent, let's say, sold to the subsidiary. In this case, the amount of, let's say, 1/5 of it, 1/5 of the 100,000 still remains with the subsidiary. So 1/5 of the 100,000 is still with the subsidiary. So let's calculate 1/5. I believe it will be 20,000 or something. So 1/5 times 100,000, you're going to have 20,000. So 20,000. So it means that this one will be goods that is still with the subsidiary at the end of the day. So what that you do is that you need to calculate the profit that the parent was supposed to get from this 20,000, because the parent is not realizing it. That's why we bring in the provision for unrealized profit. That's the PUP. So the PUP comes in. Maybe in this case they can tell you that, let's say the parent is let's say the parent calculates the profit based on markup. So if that is the markup, assume it is a markup of 20%. Markup of 20%. But we should also know that when it comes to markup is calculated on cost. Markup is not calculated on selling price. So this figure is 20,000 here. It is what? It is selling price. It is selling price. So what that you need to do is that you need to make sure that you are changing the markup to margin. You need to change the markup to margin. We need to change the markup to the margin. So if you want to calculate the PUP or provision for unrealized profit, it will be your 20% over 120 times what? 20,000. So let me see what we're going to have. So you multiply this one by 20 over 120 times. So let's say we have 3,333. So this one will be the provision for unrealized profit. And this provision for unrealized profit will be, say it's the parent selling to the subsidiary, and the subsidiary is not, was not able to sell all the goods, and this one has become a PUP. It means that the parent has already recorded this profit as part of its what? Retained earnings. So we need to go and what? Subtract it. So when you go to the group retained earnings, that's the reason why we were having PUP over there. That's the reason why we are having the PUP over there. In the same scenario, if that it was the what? The parent, if that it was the subsidiary which has sold to the parent, but the parent was not able to sell all the goods and it has left with 20,000. When you calculate and get the PUP, it will be subtracted from the net asset of the subsidiary when we are doing the workings 3. So if you go through the workings, you can see the workings 2. I brought PUP over there. So that's the reason. That's the reason. So the subsidiary too has already recognized this profit. Meanwhile, some of the goods were, not all the goods were sold. You see the thing. So that's the reason behind it. So that's the reason behind it. So then when you get the PUP, you are not done. This PUP, the same figure, was supposed to be subtracted from inventory. So you need to go and subtract this one from inventory when you are doing the group consolidated statement of financial position. So you subtract it from what? Inventory. So inventory. You bring this, you go and subtract the 333 from it. Because the reason behind it, because IAS2 value, IAS2 is inventory. IAS2 is inventory. So you value what? Inventory is, let's say, measured at a lower of cost and net realizable value. So you having so it's supposed to be at cost, but not at a selling price or at a profit. So we need to, that's why we are subtracting from inventory. Inventory is measured at lower of cost and net realizable value. So it's supposed to be a cost, lower of the cost or net realizable value. But in this case, there is what? A profit charge on it. There is a profit. So we need to go and subtract what? The profit that we have put on the inventory. So we need to go and take it up. So this one too will be subtracted from inventory when you are under the current what? Asset. Under the current asset. When you are doing the group financial what? Position. So when you start solving questions, you see what that I made proper. So that's what I will do. Then the next thing is that you also take this same figure to the cost of sales and go and add it. So you go and add it to the cost of sales. You go and add it to cost of sales. So you go and add it to cost of sales. So these are how that the treatment of goods of sale, our sale of goods is going to be done. This is how that the treatment of sale of goods is going to be done. So ladies and gentlemen, as I said, I'll pick a question, then we will go through it so that you guys will understand what that I'm trying to cut across here. So you get to understand it. So let me clear this, then let's go to goods in transit. Goods in transit. Goods in transit. Goods in transit. So we are done with goods of sale of goods. So now we are going to goods in transit. So 3. Goods in transit. Goods in transit also comes in. This one too can happen to any of them. So let's say the parent has sold some goods to the subsidiary. So the parent has made some sales to the subsidiary, and let's say in this case the goods is, let's say, 20,000. But the issue is that all the 20,000 has been recorded in the parent's book, but in the subsidiary's book, the subsidiary has not received the goods. So the subsidiary has not recorded the 20,000. The subsidiary has not recorded what? The 20,000. So because of this, that's where that brings in what we say there is a goods in transit. So the goods has not what? Reached the subsidiary. Meanwhile, in the books of the parent has already recorded the 20,000. So in a case where the parent sells goods to the subsidiary, and let's say the goods is 20,000, the parent, so let's say the parent, and we have the subsidiary here. So if that I sell goods to you on credit, if that I'm the parent, I'm selling goods to you on credit, I'll have trade receivable. So a trade receivable of 20,000. This is what I will be recorded in my books. And the subsidiary. The subsidiary will also record trade payables. Trade payables. Let's say in the books of the subsidiary has recorded what? 15,000. So you see that the parent books and the subsidiary book is not tallying. So because of this, it will bring what? Some differences. The difference will be 5,000. So the difference of 5,000 here will be the goods in transit. So we are assuming that the difference between these two is what? The goods in what transit. So you bring goods in transit here. Goods in transit. 5,000. So that it will make here to be 20,000. And here too will be what? 20,000. You get it? So that's what that I mean. So that's how that the goods in transit comes in. So when it comes to the goods in transit, what that you do is that this 20,000 will be subtracted from receivable, because we are saying that under IFRS 3, business combination, there shouldn't be any intra-group trading among the two entities, because now they are a single entity. So you go and what? You go and eliminate. So when it comes to trade receivables, you bring the parent figure, you bring the subsidiary figure, you come and subtract the figure, which is 20,000 from here. You come and subtract it from here. When it goes to trade payables, you bring the parent trade payables, the subsidiary trade payables. Then you come and subtract 15,000. You come and subtract 15,000. Then you go to inventory. So the inventory you need to come and what? Subtract. You need to come and subtract the goods in transit of what? 5,000. You come and subtract the goods in transit of 5,000. So you bring the parent. Let's say bring the parent inventory plus the subsidiary inventory. You subtract the goods in transit of what? 5,000 from it. So ladies and gentlemen, this is how the computation for goods in transit is supposed to be done. It is very, very similar to the cash in transit. It is very, very similar to the cash in transit. So this is how that the goods in transit is going to be done over here. So this is how that is going to be done. So let's quickly go to the cash in transit. Let's quickly go to cash in transit. So let me clean here so that we go to the cash in transit. So the same scenario. So let's say the parent, subsidiary. The parent has sold some goods to the subsidiary. So the goods, let's say 20,000. The worth of let's say, so the subsidiary is owing the parent of what? An amount of 20,000. So in the parent's book, the parent will be having what? Trade receivables. Then in the subsidiary book, the subsidiary will have trade payables. So it's similar to the goods in transit, because in this case, just that this one is a form of cash. This one is not in the form of goods. So here, the parent, in the parent's books, the parent is supposed to receive 20,000 from the subsidiary. But in the subsidiary books, the subsidiary is saying that my books, I'm owing you just 15,000. I'm owing you just 15,000. I'm owing you just 15,000. So this means that the subsidiary has paid some amount to the parent, but the parent has not received it. The subsidiary has paid some amount to the parent, but the parent has not received it. So that one is what we call what? Cash in transit. Cash in transit. So cash in transit, you need to come and subtract the 5,000. The moment the parent receive it, it will tend to make it be 15,000, the same as how that the subsidiary is having. So this is how that one too also means. So when you come, the trade receivables, you go and subtract the 20,000, you go and subtract the 15,000 from the trade payables. This cash in transit will be what? Will be added to our cash. So you need to go and add that of the 5,000 to our cash, so that it will make it to become the same, so that you get the same figures. So you have the same figures. That's how that the cash in transit and other stuff is going to be. So you subtract the 20,000 and all those stuff from it, then you are good to go. That's it. So your trade receivables under your consolidated statement of financial position, you add the your parent trade receivable, your subsidiary, you subtract the 20,000, your cash in transit, you come and add it. So you come and okay, when it comes to the cash, since we are receiving it, since we are the one receiving this amount, so you need to go and add it to our cash. So you need to go and add it to our cash. So then you come and subtract the 15,000. So let me write it so that you get it right. So the trade receivables, you bring the parent plus the subsidiary. Then you come and subtract the 20,000. Then the trade payables, you bring the parent trade payables, the subsidiary. Then you come and subtract the 15,000. Then when you go to the cash, you bring the parent cash plus the subsidiary cash. Then you come and add the cash in transit, because we are going to receive it, cash in transit to it. So ladies and gentlemen, this one also ends the cash in transit. Then the last part of it will be the reconciliation of current asset. The reconciliation of current asset. So let me deal with that. Then we just move on with some other aspect. I hope. Let me see if that I have not tackled it. The cash in the current asset. Okay. So like the reconciliation of the current asset, that's what that makes up with the goods in transit and the other aspect, because all these things form under the current asset item. So the goods in transit and the cash in transit. So all these things form below the reconciliation of current asset. So ladies and gentlemen, this ends the intra-group trading. And since we are done with all the 5 basic workings and the intra-group trading, I can assure you that anytime you pick any consolidated financial statement figure, you'll be able to tackle it. And I will show you how you should go by answering some questions when it comes to you dealing with the income statement aspect, and also the statement of financial position, and how to calculate for goodwill. So we will start with a question. I'll bring a tactical question so that you look to it. Maybe we can solve 1 or 2 questions so that you guys will be okay with it. So that anytime you see any question, you'll be able to tackle it. You are not going to be finding it, because since that you have come to Executive Masterclass Tutorial Center, here is an icon of academic excellence, and you are delivering the best. We are delivering from our own understanding. What that we have used, what that we have gotten, the idea that we have gotten from schools, from books that we have read, and from our professional aspect. That's what we are implementing here. So if that you are here with us, you are not at a wrong place. You are at a good place, or a proper place that all your academic challenges are going to be met. So thank you for being with us today, and I will also bring a tactical question which talks about how that consolidation is going to be solved, or how you're going to analyze your financial statement when it comes to consolidation. Thank you.